In this part of the video, let's talk a little bit more about brokers and different types of transactions, right? So, in general, a broker, that's somebody that handles your buy and sell orders for investors. Um, Typically, these people have to pass a test to be able to buy and sell stocks and bonds. You need to have what's referred to as Series 7, but there are other licenses that you can take and sometimes you must take. Um, there's something called Series 6 that if you only wanted to market mutual funds and variable annuities, you could that's a license that you could get for that kind of business. But there are also different exams for different positions in a company. So a supervisor, there is a series exam for a supervisor. I don't know the number of that. But again, how these people ultimately get paid then is by placing an order. Um, there's a commission. Everybody's aware and have heard of commissions before, right? So brokers make money from buying and selling securities. And this is one of the things that we have to always keep in mind when you're purchasing stocks, right? Is you have to pay to play, right? You have to pay to buy, but you also have to pay to sell. Now, with the addition of the new kinds of So as I was mentioning there, it turns out with the new free to trade types of software that's out there, like Robinhood, etc., sometimes you don't pay commissions. Now, to have an account, you almost always have to pay a fee for an account. So you need to be aware that there are always costs. There's no such thing as a free lunch in this world. When we think about pricing, right? What price do you see? So if you were to go out to Yahoo Finance and find a company stock, you would have actually two prices to view. The bid quote, that's the highest price a market maker is willing to pay for a security. So that's the highest price an investor can sell the stock. So if you think about being the seller, right, the bid price is kind of like the wholesale price, right? That's what you would be willing to sell the stock for. The ask price is kind of like the retail. That's the price that you would be willing to buy the stock for. So we have what's referred to as a bid-ask spread. That's the difference between the two. So that's the amount that the market maker earns, and that's obviously the cost to the investor of making the trades. Now, in general, there's something referred to as a market order. You place an order, right? Tell the broker you're going to buy or sell a certain stock, right? Now, you can tell them specifically at a certain price if you want. You can be very specific with the details. But you could just say, I want you to sell my 1,000 shares of P&G. Whatever the price is, that's the price that it gets sold for. If you look here, we can see the bid ask price here, right? So the bid is $74.84. You notice the ask is $74.86. So if you wanted to buy this stock, you would pay $74.86. If you were selling the stock, you would sell it for $74.84. So it turns out that the broker here is going to make 2 cents for every share that you transact, whether you're buying or selling. That's the price that you earn or that the broker earns on this. Again, looking at this more about stock price, obviously here's the current price. They tell you the date here. This is on at 11:12 a.m. on this particular day. It's up 63 cents for the day, which is a 0.85% increase. We also can get lots of other information. This all comes from Yahoo Finance. So let's go back to our market order characteristics again. We can do what's referred to as a limit order. It states a specific price for the broker to buy or sell. Now, besides the limit order, right, buy P&G at $90, besides that, we have to tell them when to place the order. If you just say buy P&G, they're going to go out and whatever the price is, that's the price that you're going to buy it at. However, if you say, look, buy P&G if it gets to $100, it's not at $100. So the broker is going to wait till the price gets to $100 before they do whatever you told them to do, buy or sell. How long do we want them to wait for that? Well, you can do what's referred to as fill or kill. If you can't do it at that particular time, the order is done. So you either do it or it's over. You could do a day order. So at the end of the day, if the stock price didn't go to $100, the order is then canceled. Or you could do a good till canceled order. Say, hey, keep this open for till next Friday. Again, it'll say open till next Friday. If it gets to $100, the transaction is going to happen. We also have something called a stop order. This is a sell order at a specific price. This is to limit an investor's loss or to assure a profit. Now, these two things sound an awful lot. This is a stop order as well, placed to limit a loss in a particular position. I think they are kind of synonyms with each other. But again, the idea here is maybe you want to protect some profit. Let's say you have a stock that you purchased at $45 and now it's at $60. You can place a stop order. What's the stop order? If the price falls to $50, I want you to sell. This saves $5 in profit that you would make. So it's not worth 60 anymore. Now it's worth 50. It's going the wrong way. You want to sell it before it gets to 45, so at least you have $5 in profit. That's how a stop order will work. You could also tell them to buy 100 shares at $50. So when the price gets to $50, they buy. How long does it stay open? You got to tell them. We have two kinds of accounts. We have cash accounts and margin accounts. The beginning investor really understands cash accounts because that's the way we buy and sell things as consumers, right? You have to have cash in your account to cover any purchases you made. A margin account, though, allows you to borrow money from the broker. Now, obviously, when I use the word borrowed money, you need to understand now that there is an interest. And the interest on margin accounts is not always low, right? It could be 10, 11%. So again, you have to understand you're borrowing money and there's a cost to that. There is what we refer to as an initial margin. That's the minimum amount for stock purchases. Now, the Federal Reserve chooses this, and at the most, it's 50%. So if the stock costs $100, you could actually buy 2 shares because you only have to pay half and you borrow the other half. So your equity is the part of that stock that you actually own. So if you take the stock value, subtract out the debt, the loan that you have on that stock, divided by the stock value, that tells you your percent equity. Now, they also have what's referred to as a maintenance margin. Typically, that's 25 or 30%. So if your equity falls below 25 or 30%, you now have what we would ultimately call a margin call, right? They would want you to bring your account back up to that 25 or 30% at a minimum. So the margin debt, that's the amount you borrowed. Equity is the amount that you own. So if you buy stock selling at $10,000 at 50% margin, you pay 5%, $5,000. So the margin 10,000 minus 5,000 divided by 10 is 50%. Let's say the stock goes to $12,000. Now your equity has changed because now the stock is worth more. So now 12 minus 5, the loan, that's 7 divided by 12, that's 58%. So your equity has grown. So what do you think would happen if instead of it went to 12,000, what if it went to 8,000? Now your equity piece decreases. And if you would fall below that maintenance margin, you ultimately then would have a margin call. And again, here we have that example. But here we're just answering this question. How far does the stock price have to fall in order for there to be a margin call? So here we have X, that's the value that we're looking at. So we purchased this for $2,500 of stock, 50% cash, 50% debt. How far can it fall before the margin reaches 30%? So again, 2,500 is the amount that we borrowed. X minus the 2,500. We're going to solve for X here. We would need $3,571 is how far the stock could fall in total value before there would be a margin call on the shares. So what are the risks of buying at margin? You're going to be charged interest. Brokers can set a higher margin rate without notice. There are no extensions on margin calls. They are due end of day. The broker can decide which assets to sell to cover the margin, right? Where's this money going to come from? It's going to come from your account. Well, they could take shares that you have in your account. They could sell those shares to meet the margin piece. And of course, it's possible to lose more money than you've invested, and then you wouldn't have money to cover any losses. The next thing to talk about is something called a short sale. This is selling borrowed stock to profit from a falling price. So again, you can make money in the stock market when stocks either go up or if they go down. So how does that work? So let's say you're going to borrow 100 shares from your broker. You think the stock price is going to fall. So you sell the stock for $1,000. Now you're going to wait and see what happens. When the stock price actually falls, let's say it falls to $950, you would buy it back and then you would return the shares to the broker, keeping the profit, which is that $50. So if the stock goes the wrong direction, if the stock goes up, you lose money. But if it goes down, that way you're making profit when the stock actually goes the south, right? Loses money. So if you kind of think about buying, we always think about you buy things and then you sell them later. This is just doing it in reverse order, right? So again, you borrow shares you think are going to drop in price. So you get the current higher price. When that stock falls, you buy at the lower price and you return it to the person you borrowed from. Again, you borrowed. There's interest. What happens if this stock pays a dividend? The person that you sold their stock, they don't get the dividend. You're going to have to make up the dividend payment as well. So how does the short interest work? So short interest is the number of shares sold in a firm. So there is a ratio. This is a short interest as a percentage of the average day's stock volume. So you take the equity, how much is owned of the stock, and you divide it by the current stock value. So the percentage equity in a short sale, take the stock value when you sold it, add to it any cash, subtract to it the current stock value, divide it by the current stock value. This gives you your current equity position. So a short squeeze is when you have pressure on short sellers through margin calls, right? Again, if the stock price starts to rise rapidly, you're going to get a margin call if you have a short position. So again, the short interest ratios published tells you in general, are people increasing the amount of shorts on a stock or not? Some investors are called contrarians, right? They review this number. They say, look, if everybody is short selling, everybody think it's going down, most of the time they're always wrong. So we're going to buy the stock because that might mean it's going to go up. So the claim is that the signal investors are having a negative view of the firm. Contrarian says they're wrong, so they're actually going to go out and buy this stock. And the short squeeze represents the outcome of being wrong when you short sell a stock. There are several regulations that are kind of important. I don't get too hung up with regulations myself. The Securities Act of 33, it regulates initial stock issues or the primary market. Securities Act of 34 um, deals with transactions after the first one. So it works with the uh, creating licenses. It deals with reporting requirements of companies. It actually helped to create the Securities and Exchange Commission. Companies have to provide lots of reports. The primary report that we always look at or try to review is something called a 10K. It's an annual report. There are also 10Qs that are quarterly. An 8K is if anything happened in the last month or so that affects the value of the company, you have to report that to the SEC. 13D is kind of important because it requires any individuals who acquire more than 5% or more of a publicly held company to report that they've purchased those shares. So actually any transaction by people that own 5% or more have to be reported. And of course, we can get these reports through various publication companies. One other regulation, just to kind of mention, is the Sarbanes-Oxley Act. Everybody kind of gets beat up in the academic world lately, but basically, this act is very important. It says that auditors have to be independent. Um, there were some issues with what you might call collusion, with auditors being a little bit too friendly with the companies they were looking at. It created an accounting oversight board. It looks at corporate responsibility, right? Management has to disclose trades of companies' securities. Um, there are conflicts of interest, corporate fraud, accountability. All of those things are accounted for in this Sarbanes-Oxley Act. And finally, the last thing is to talk about, is your money safe at a brokerage home or a brokerage firm? So, as you're probably well aware, there's something called the FDIC at a bank. So, at a bank, your money in any one Social Security number is insured up to $250,000. So, if you had $200,000 in a bank and that bank went bankrupt, the insurance company would pay you your $200,000. If you had $300,000 in there, you would get $200,000. But now the other $100,000, you're now a creditor, waiting to get paid from a bankrupt company. SIPC does the same thing. So the SPIC insures up to $500,000 for bankruptcy and fraud. Now, what it doesn't take into account for is change of value. So if you bought it for $100 and it went to 150, as I understand it, you're only paid for the value that you paid for the shares. I could be wrong with that, but that's as I understand those exchanges. So again, that's the end of our introduction about brokers and the marketplace in general. Look forward to seeing you next time.